Now, I'm sure a few of you guys would have heard of the American billionaire by the name of Carl Icahn, net worth of $18.7 billion. Well, he controls a stock called ICAHN Enterprises, which you can actually buy into on the Nasdaq Stock Exchange. So ICAHN Enterprises is an American conglomerate. By the way, whenever you hear the word conglomerate, this just means it's a big company with a bunch of different parts to it. And this company has a lot of different parts to it. They are invested in various industries including auto parts, energy, metals, rail cars, casinos, food packaging, real estate, and home fashion. A very well diversified stock. And a lot of these investments pay a really high yield. If we put them all together and buy the stock, we get a yield of 9.4%, meaning if the dividend can be sustained, we can pretty much get our full investment returned in dividends in about 10 years. But the only problem with the stock is that it has a bunch of distinct parts to it, which makes it a lot harder to understand for the individual investor. This is a stock that definitely needs a lot of homework done before buying, but there's a lot of potential there. And yeah, this is quite a well-known company. AT&T is the world's largest telecommunications company, the second largest provider of mobile telephone services, and the largest provider of fixed telephone services in the United States. So if you live in the USA, the odds are you know AT&T. But the nice thing about owning the company, AT&T, the stock, is that they pay a dividend of 6.6%, which everyone knows that in this market, it's really good. But you know, the question turns to, can they continue to pay that dividend into the future? And at the moment, they are earning $2.85 per share, and they pay out $2.04 of their earnings. So they're paying out about 70% of their earnings, leaving 30% for further retained earnings in the business, which gives them a bit of room for upholding that dividend. If we look at their earnings growth, it's been a bit up and down. 2015 to 2016, it went down. 2016 to 2017, it doubled. In 2017 to 2018, it shrunk down again. But analysts do expect AT&T to be able to grow their earnings in the future at 4.8%. And if we look at their dividend history, they have been really solid with consistently increasing those dividends. For almost 15 years now, they have been increasing their dividends, which is great to see. It was just in 2003 where they played around a bit with dividends, decreased it, increased it, decreased it, and then increased it again. But after that period, they have been nice and consistent. So now I'm going to take you to a company called TELECOM Argentina, and it pays a really high dividend. This stock is the major local telephone company for the northern part of Argentina, but it is available on the New York Stock Exchange through the ticker symbol TEO. So this company just provides a bunch of telephone related services, including internet, data transmission, and IT. Now, you can see why the market has priced this stock to deliver a dividend with a 15% yield to price, because one might argue that the telephones are required less these days. Even mobile phones, a lot of people just use WhatsApp, Facebook Messenger, or Skype to contact family or friends, so they don't need the network as much. But they are also in the internet business, TEO, which is growing. And now, I got to be honest, when I look at their figures, I have seen worse ones in my day. Sales have been increasing throughout the year, earnings per share doing well, increased by a lot over the past 10 years. They've been reducing debt, as the debt to equity, it has pretty much been declining since 2006, and right now their debt to equity is 0.35. This is always a positive for me, guys, as I tend to avoid companies with high amounts of debt. But if we go into their current earnings, they are negative year to date, and this is why, due to two bad quarters in 2018. But they are expected to report positive earnings for the next report, so they can change things around. And that's why you need to work out before buying the stock. How will their earnings be in the next couple of years? And can I understand this Argentinian company? That's the question you should ask yourself. And yes, this may take a bit of time to get your head around, but it could be worth it. A 15% dividend, not bad. Okay, so this stock's dividend is significantly lower than the previous stocks, but it is also a lot less risky. So BP is obviously the worldwide oil and gas company, and this stock is pretty much engaged in everything to do with oil and gas, including exploration and production, refining, distributing, petrochemicals, power generation, and trading. Then on top of this, they have the renewable interest segments in biofuels and wind power. And recently I read an article by someone from the Motley Fool UK who recommended this stock, and he was talking about factors such as rising underlying profits. He thinks that the dividend that is around 6% is safe, and he thinks it is a good stock for an income portfolio. And I personally don't think BP is the worst stock to own. They are paying a dividend that is within their earnings. They're quite a big company with a market cap of $140 billion. Their forward PE is low at 14. They have a reasonable amount of book value per share of around $30. Their debt to equity, that's perfectly fine, 0.54. Their current ratio is a little low for me at 1.18. I personally would like that ratio quite a bit higher, but that's just me, and also Warren Buffett would as well. He likes a current ratio of 1.5 or above. And obviously their return on equity and return on assets is pretty poor, but they're a cash cow company, not a growth company, and that's what you can expect. Right, I have talked about the stock before, but there is nothing wrong with mentioning the stock twice, especially when it's a stock that Dividend Sensei, the dividend stock expert who writes at Seeking Alpha, he likes the stock. And he has actually recommended this stock before in a podcast. Anyway, ENBRIDGE is actually the Canadian energy company that transports, distributes, and generates energy throughout North America. In fact, ENBRIDGE own and operate Canada's largest natural gas distribution network. And Dividend Sensei has actually just released an article saying why this 6% yielding blue chip is a table pounding buy. And he's got a number of interesting points in this article. And by the way, before I talk about those points, I would recommend to you guys who are interested in dividend stocks to subscribe to this guy's articles. Anyway, his game is dividends and he knows them really well. Anyway, with regards to ENBRIDGE, he talks about how it will soon be a dividend aristocrat, as it has consistently increased dividends for almost 25 years in a row. Then he also shows how ENBRIDGE has delivered a superior return to its shareholders over the past 20 years. He also talks about the safe dividend because of their low risk business model with long-term contracts and regulations. And he thinks that ENBRIDGE is likely to deliver over 15% in the long term, so that's pretty good. Anyway, I'll leave a link in the description to this article if you want to look into it further. Okay, so this stock is a real estate investing trust, and as I'm sure you can all guess, they focus on acquiring, financing, and owning real estate property to be leased for gaming and leisure purposes, as in the name of the stock. The company owns 73.6 acres and leases 32.1 acres in Indiana for a gaming vessel, which includes a Hollywood-themed casino riverboat, an entertainment pavilion, and a 295-room hotel. And this stock has been able to grow both its revenues and earnings at a solid rate. Also, when the full 2018 figures get released, it appears it will show even further growth in both of these numbers. But this stock is quite a volatile stock, as you can see from their 5-year past trends, and it is currently selling for a price of $36.50. But the one problem that I do have with this stock is their debt. They have $5.85 billion in debt, and their total equity is only $7.8 billion. So let's see how they handle their debt. So this is a stock that has a lot of upside potential at the current price, and I've seen a lot of value investors who are attracted to this stock. Also, the legendary investor Carl Icahn has a pretty decent stake in the stock, and recently he has added further to his position in NEWELL Brands. So NEWELL Brands is a worldwide marketer of consumer and commercial products, and they have a whole portfolio of brands under their company. I'm sure a lot of you Americans will recognize these brands that are owned by NEWELL. Now, NEWELL have had, let's just say, a bit of problems lately. Management got over exuberant and made some crazy and expensive acquisitions. And this is one of the reasons why the stock has fell by 70% over just, the last year and a half. At the time of making this video, the price is starting to look fairly attractive, $16 per share. And what's good is, as I said before, we got ICAHN on board, who is known for turning around bad management in companies. Now, we all know, actually a lot of you probably don't, but ICAHN loves to buy companies that, in his own words, no one wants. He's a contrarian investor, looking for value. What he then does generally is calls for a new board of directors, and he turns the company around. So, for those of you who believe in ICAHN and like that 5.7% dividend, then dig deeper into the situation going on at NEWELL. This stock has caught a lot of investors' eyes, especially the dividend and value investing community. And now I want to finish off with a ridiculously high dividend yield stock, actually one of the highest yielding stocks on the American market, just as a bonus pick and to see if there's any potential there. So, UNITI is a real estate investment trust engaged in the acquisition and construction of infrastructure in the communications industry. The company focuses on acquiring and constructing fiber optic broadband networks, wireless communication towers, copper and coaxial broadband networks, and data centers. So, it's one of those companies that are engaged in an extremely niched product. Now, the reason why the stock is paying such a high dividend, 25%, is because of a lot of their business is derived from a company called Windstream, and Windstream have recently filed for bankruptcy. Now the question becomes, will Windstream accept or reject its lease agreement, and will UNITI be able to keep sustaining such a huge part of their dividend? So again, guys, this is one of those stocks that you really got to do your homework on. I don't think they will be able to sustain their dividend at all. I mean, some people are even thinking of cutting the dividend altogether, but let's see how it plays out. And if you're an opportunity hunter, you may want to spend some time delving into this stock.